G'day traders. Here at ATS, Fred and I have been busy finalising our new in-house workflow process used to compile robust, diversified trend-following portfolios within the Metatrader 4 environment. This new version, titled ATS 24, is a major revision of our old workflow process, ATS 22. And this automated workflow process is used by our forum members who are retail traders to compile their portfolios within the Metatrader 4 environment using contracts for difference, or CFDs. Now, CFDs are a solution for traders with limited capital to practice the methods deployed by some of the very successful globally diversified systematic trend followers who use futures. But by using CFD products, we can also obtain a similar margin exposure by using Forex, equity indices, commodities, cryptocurrencies, shares, ETFs, and currency indices. So we provide a training ground at ATS for retail traders to get their feet wet in the principles and practices deployed by some of the most successful fund managers in the world to hopefully build the competencies of a retail trader to a position where they can choose to either invest with these fund managers or they can adopt the method for themselves if they want a do-it-yourself solution. So ATS 24 represents a major update of our earlier ATS 22 process, and we've sought to streamline the process further with some powerful code additions to improve the systematic nature of our entire workflow process and ensure that the outputs generated are tailored to each trader's available investment capital and their choice of retail broker. We don't provide algorithms to trade with at ATS, but we do provide a process that allows a trader who adopts these processes to generate output algorithms themselves according to their individual requirements. There are now 8 steps to the revised workflow process which use algorithms to take discretion out of our hands and use extensive historical data sets to assist in our decision-making process at each step of the way. Now, we won't go into the detail of each step of the workflow in this particular video episode, as we'll be reviewing each step later in this series. But once you've become familiar with this 8-step process, then the task of compiling your own diversified systematic trend following portfolios is far simpler and less time consuming than what you will find using alternate third-party software. So this process is custom built with the needs of the systematic trend follower in mind. We adopt the philosophy of trend following into the design of our trend following models and into the workflow process logic to ensure that the outputs generated are robust to market regime variability and adaptive to new emerging trending conditions. Rather than labour on about the significant benefits of a diversified systematic trend following process, which you can find in many of our prior YouTube presentations on our ATS channel, I thought that this time I'd prepare a YouTube series that focuses on the workflow process itself to assist our members and also pique the interest of interested viewers who might like to become a member. So in this video series, we will be going from back to front, where we first demonstrate the final outputs of the workflow process, which will be the subject of this video, and then we'll progressively step through the 8-stage process in later videos. So now that we've got the introduction out of the way, let's have a look at the final outputs of this workflow process in this episode, and in future episodes we'll provide an overview of the systematic steps taken to arrive at this outcome. So here is the result of a process that is applied to 48 markets over a 42-year history, comprising many different market regimes. And what looks like spaghetti are the return streams of 48 different markets, all represented in the legend below. To generate each of these market return streams, we used 8 different unique trend following models which were generated through our workflow process. And we therefore generated, in this example, 48 markets with 8 trend following models apiece, or 384 separate return streams from our workflow process to create this particular portfolio. So what you are seeing are the return streams from different markets, but not all the return streams generated from the entire process. Now, while this vast array of return streams looks like a mess of spaghetti, you can see that despite their volatile nature of each individual return stream, that each of these return streams has a slight overall positive expectancy over the course of the history. Each of these return streams have demonstrated their ability to survive over a vast array of different market environments and have generated sufficient performance to exhibit a weak edge, aka a small positive expectancy. Furthermore, while it is hard to visually see as it appears to be a mess, the fairly unique volatile nature of the return streams offer correlation offsets to reduce overall drawdown of the portfolio when markets do not exhibit strong trending regimes, and positively correlated amplifications when markets enter broad trending regimes. So, I have circled regions in blue in this array of return streams that offer correlation benefits. In other words, they amplify positive performance by lifting the equity curve, and regions in red where trends are generally absent, yet the uncorrelated nature of each return stream provides correlation offsets which help to reduce adverse drawdowns. Now, while this chart of spaghetti provides a display of the performance of an 8-system ensemble of trend-following systems applied to each different market, let's see what happens when we compile these individual return streams into a consolidated performance result. So here we are. If we look closely at this portfolio result, we can see where correlation amplifications from catching outliers has lifted the equity curve, such as here, 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 and here, and where correlation offsets during non-trending regimes has limited drawdowns and has resulted in portfolio stagnation as opposed to portfolio performance decline, such as these periods here and here. Now, before we get too excited about this beautiful result from our workflow process, we need to understand the following very important things. Firstly, never trust a backtest unless you understand the processes used to forge its outcome. A backtest to a naive observer appears to be a valid method to provide a basis to assess model performance, but here is the rub. You need to understand what component of that backtest was used for model development, referred to as the in-sample component, and what proportion of that backtest represents the performance result over unseen data. You may as well completely disregard the in-sample component of that backtest, as the performance result is a fugazi. And you know what a fugazi is, don't you?
Right? It's all a fugazi. You know what a fugazi is?
Oh, fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
So now let's have a look at some of the statistics generated by the entire backtest, which includes the in-sample and out-of-sample performance data, to see how we can clearly be misled by the result. So from the number of trades here, we would assume that 25,638 trades would provide statistical validity to our method. We would also assume that the drawdown of 8.9% was a representative maximum drawdown to expect on unseen data, and we would assume an average yearly return of 35.6%, or a compound annual growth rate of 6.68% was an expected result we could apply as a performance benchmark. But all of these assumptions are wrong, as the backtest result has been contaminated with overfitting. You see, there is no way we can eliminate effects of overfitting if we use performance results derived from an entire backtest. We must disregard the in-sample performance when evaluating the robustness of a trend-following portfolio. In fact, for the trained eye, we can undertake a bit of forensic examination to possibly identify that part of the backtest result that might be overfit. So let's use a bit of critical logic to evaluate the backtest produced by our workflow process and identify which components of that backtest may be contributing to an overconfident illusion. So have a look at the relationship in this equity curve between the equity curve itself and the drawdown profile. Notice for half of the backtest that we find that we have a trajectory of our equity curve which is significantly different or lower than the trajectory post the year 2000 going forward. This tends to suggest that unless there is something in the data that is driving this different trajectory, we might be suspect that this area of the equity curve might be overfit. Also, when we look at the drawdown profile, we notice that the drawdown profile seems much more volatile up until the year 2000, but then going beyond 2000, almost up to current day, we see a far lower drawdown profile. This should be making us suspect that this part of the backtest result produced from our workflow might be overfit to the data. Now, this is not to say that an overfit backtest is a bad symptom. In fact, it is a result produced when developing any trading strategy using historical data to select suitable trading scenarios. So, every backtest used to define system parameters is going to be overfit. What is essential, however, is that we do not use the performance results of the in-sample backtest to make any assessment of how a backtest is going to perform on unseen data. To make that assessment, you must use out-of-sample data. So now, with an actual understanding of our workflow process, we can plot exactly the out-of-sample and in-sample components of the backtest, as we can exactly then determine which part of the data was used to develop our trading strategies for our portfolio. An entire backtest result is therefore inevitably over-optimistic, as it contains results generated from in-sample processes and results derived from out-of-sample processes. You cannot use results from in-sample processes as a basis to benchmark future performance. Aside from this overfitting propensity of all backtests, there is not a way we can use any result from a backtest to estimate future performance with our trend-following models. Our performance is heavily dependent on the presence of outliers in the market data, which simply cannot be predicted in advance. The future is going to be different to the past, so this entire backtest result must be viewed in terms of performance based on a historical record only. We cannot infer from this historical record how the models are going to work in the future. Now, despite this limitation of any backtest, there is valuable information we can take from a historical backtest that tells us something about a model's robustness. So, from our entire backtest result, this is what we can take from it. The portfolio, as an ensemble of return streams, has been sufficiently robust to survive a long-term historical dataset that comprises an array of different market conditions. This is a good feature. The combination of return streams has managed to keep drawdowns relatively low while delivering strong returns over the period. This is another good feature. And there does not appear to be any significant risk weakness in the ensemble combination in respect to what history has presented to us. So far so good. But now it's time to discard the in-sample component and evaluate performance of the out-of-sample data. After all, we'll be using this portfolio of trading strategies to navigate an unwritten future. Now, from our workflow process, we've used the period 1st of January 2000 to the 31st of December 2020 for all our strategy development and selection processes. So we can therefore plot this in sample region on the chart, and we can therefore clearly see the out of sample regions. And in our workflow process we undertook for this backtest, we therefore have performance results from the 1st of January 1980 to the 31st of December 1999, and the region from the 1st of January 2021 to the 31st of May 2022 to work with as out of sample regions. And if we assess the performance over this unseen data, this will give us a far better performance guide to understand how our portfolio may perform under future conditions of uncertainty. So let's use these out of sample regions to turn down our overconfidence generated from the entire backtest. Reducing expectations is so important in assessing backtest performance, given the propensity of a backtest to over-exaggerate performance results. So let's have a look at the out of sample regions of our backtest, these areas here, and revise our opinion about historical trajectories. Using the out of sample component, we can revise our estimate of the compound annual growth rate over unseen data. So looking at the out of sample component, we can revise our estimate with the assumption that on unseen data, the compound annual growth rate will be far lower than the result produced by the in-sample component. We can therefore plot a more conservative trajectory to make our performance expectations far more realistic. But notice how the out-of-sample component from the 1st of January 2021 to the 31st of May 2022, which is this section here, this trajectory, carries with it a steeper trajectory than the conservative estimate from our earlier out-of-sample portion. This is a great sign that our portfolio is currently responding to trending conditions very well. That is what we want to see with more recent out-of-sample data, as it gives us confidence that the portfolio we'll be taking to the live environment is currently performing well. But now let's look at the drawdown profile. Clearly, the overfit portion of the backtest possesses unrealistic drawdowns from overfitting. It is far better to use the worst case maximum drawdown from the out of sample portion of the backtest to provide you with a more conservative opinion of the real volatility that resides in your portfolio when presented with unseen data. Furthermore, the use of maximum drawdown as a percentage can also be deceptive. It is far better to view the maximum drawdown in dollar terms, as the maximum drawdown can occur anywhere over the term of the investment horizon. If we relocate the maximum drawdown to a position early on in the time series, the impact of that drawdown will be far more dramatic. As we'll observe shortly, the maximum drawdown here of 9% on equity increases to a maximum drawdown here of approximately 45% if the drawdown occurs immediately following the implementation of the backtest. Of course, we can never be sure when or where the maximum drawdown is going to be found over the investment horizon. However, it is very important to note that as your sample size increases on unseen data, typically your maximum drawdown will possibly go to even higher values, and as a conservative estimate, we could assume that in the long-term distant future, our maximum drawdown might be double what is observed over this long-term backtest. But now let's have a look at the monthly performance data of the out-of-sample component of the backtest. And first, let's look at the out-of-sample portion between the 1st of January 1980 to the 31st of December 1999. As we observe the annual performance results, which is in this column, most of the annual performance results produced a great annualized return on a $200,000 initial account. 1987, down here, produced a magnificent performance return of $87,000 or 44%, and 1996 produced a massive annual return of $121,000 or 61%. This tells us that the portfolio performed exceptionally well during these historic regimes, but it was not without its losses. In fact, in 1998 and 1999, sizable losses were incurred, resulting in the maximum drawdown at the end of this out-of-sample period. Now let's look at the most recent out-of-sample performance between the 1st of January 2021 and the 5th of May 2022. Here we can see a small loss for 2021, but a very solid performance year to date for 2022. I told you to reduce your expectations, didn't I? But this out-of-sample portion at least demonstrates fairly strong performance, generating 35% on a $200,000 account over this 17-month period. Clearly, we are experiencing a strongly trending regime which is favourable to our portfolio. So given that our portfolio is performing strongly in a strongly trending regime, we can be confident that the portfolio result does what we want it to do. As a final cross-check regarding assessing the performance of our portfolio that has been generated through our workflow process, we can look at the important statistics derived from the out-of-sample portions of the backtest. Firstly, let's look at the sample size. In this case, for this out-of-sample period between 1st of January 1980 to the 31st of December 1999, the sample size was 8,856. In this case, it's a sufficient sample size to give us confidence in the quality of the statistics generated by this report. We also pay close attention to the winning percentage. A point of note is that most trend following systems have a winning percent of 40% or even less, but do not be surprised by the relatively high win rate for a backtest using our workflow process. In this case, our winning percentage is 44.7%. The reason for this relatively high winning percentage is due to some of the tricks we have up our sleeve in the workflow process, which we'll get to that later in future episodes. The average win and the average loss are also very important statistics to us. We as trend followers demand a far higher win in dollar terms than our average loss, as we cut losses short and let profits run. And if we see this result respected, then we can be more confident that the golden rules of trend following have been baked into our process. In this case, our average win is almost double that of our average loss, which is to be expected by any trend following process. Also, the largest win and the largest loss are also important statistics to us. The largest win in dollar terms against the largest loss in dollar terms tells us whether we are successfully hunting for these outliers. In this case, if we find that our largest win is far higher than our largest loss, we can be confident that our process is capturing outliers. In this example, we see our largest win is about 26 times our largest loss, or 48 times our average loss. This ticks the box that our method captures outliers and that our method possesses positive skew in our return profile. Furthermore, we can also look at the maximum consecutive wins and the maximum consecutive losses to give us an idea of the sequence of possible losses we might expect when navigating an uncertain future. Knowing that our backtest produced 32 consecutive losses in a row is actually a good thing to know when you are experiencing a very unfavourable trending regime in the future and you want to know whether your models are broken or not. We can also refer to the compound annual growth rate, or CAGR, to give us an idea of the compounded returns that were generated over this out-of-sample period. And also we can look at the maximum drawdown in percent terms and dollar terms, which is important to us to reduce our performance expectations. Now let's look at the statistics generated from the more recent out-of-sample component of the backtest from the 1st of January 2021 to the 31st of May 2022. Here we see that we have a trade sample size of 1,230 trades, which is significantly less than the prior out-of-sample component, but still fairly high and sufficient for us to draw some conclusions. We see that the win percentage is similar at 47.8% winning trades. The average win is larger than the average loss. The largest win is 12 times the size of the largest loss and 18 times larger than the average loss. And also we see that the compound annual growth rate, and we see a low drawdown in percentage and dollar terms. And this overall gives us great confidence that we have a portfolio that we can now take to the live trading environment. But before we leave our discussion about the portfolio results produced from the process, there is another matter that we need to share with you. We actually only implement this particular portfolio for 12 months after an incubation phase, which we'll discuss later in our workflow process. But the reason we undertake this workflow process annually is to keep our portfolios razor sharp and responsive to new market conditions as they arise over time, with more future data added to our process. So our workflow process is an adaptive process that continually keeps our portfolio current and responsive to the trends of today. But more about that later on. So that just about wraps up this first episode about our new workflow process. In this episode, we started from back to front, where we showcased the final outputs of a diversified systematic trend following portfolio, which, after a fairly rigorous examination, we are confident about taking to the live trading environment for the next 12 months before we undertake the entire workflow process again. In future episodes in this series, which will be coming out over the next few weeks, we're going to go under the hood to explore the actual systematic processes we use to generate these outputs. So, stay tuned to this series, and thanks for watching.